Welcome to the deep dive. We take sources, pull out the key insights, and hopefully help you get, well, truly informed. Today, we're diving into something that maybe feels a bit conservative, especially with all the noise about tech stocks and, the market always hitting new highs. We are talking about bonds, the often underestimated, maybe sometimes unloved, role of bonds in your portfolio.
It's a really foundational topic, actually.
Yeah.
Absolutely critical if you're navigating the investment world. And we're digging into some really seminal texts here. We've got John Bogle's Common Sense on Mutual Funds and Benjamin Graham's The Intelligent Investor, plus security analysis that he did with David Dodd. Real cornerstone.
Yeah, classic stuff. And our mission, really, is to figure out why bonds genuinely matter, even when stocks seem like the only game in town. We want to see how they stabilize things, how they reduce risk, and maybe how they actually help you become a more confident long-term investor. Because you might be thinking, why bother with bonds? They seem so sedate,
Yeah.
compared to chasing those big stock market gains. Let's unpack that. So, right off the bat, these sources highlight something powerful, something that keeps coming up. This sometimes irrational exuberance around stocks. Benjamin Graham, he lived through some wild market swings. He famously said the market is like a pendulum that forever swings between unsustainable optimism and unjustified pessimism.
And what's really striking is just how consistent that pattern is, historically speaking. Graham, writing, way back, identified this new era investment theory from the 1920s. The idea was basically that common stocks were the best thing ever, long-term, almost no matter the price you paid.
Right. Sounds familiar, actually.
Doesn't it? And Graham's take, he was blunt. He called it incredibly absurd.
And Bogle, fast forward a few decades, he echoes that same idea. He talks about these periods of buoyant optimism where stock returns just get way out ahead of the fundamental returns, the actual company earnings and value. He points to like 1982 to 1997, amazing returns for U.S. stocks, like 16.7% a year nominally. Incredible.
Right. Huge numbers.
But then, as he puts it, those gains just began to melt away in the following years, like 1997 to 2009. Returns were barely positive.
It's a stark reminder, isn't it? What goes up
Can definitely come down, and often does. And to put some numbers on those swings, the actual volatility of stock returns, it's gone up over time. Since 1926, the standard deviation hit 20.4%.
Okay, standard deviation. Break that down a bit.
Right. Simply put, it's just a measure of how much your returns tend to bounce around the average. So a 20.4% standard deviation means in any given year, your stock returns could easily swing, more than 20% up or down from the average. That's a wild ride.
Yeah, emotionally taxing too, not just financially.
Exactly. Which leads to this big question Graham always asks. If the future is basically unknowable, and he says, investing on the basis of projection is a fool's errand, well, where does that leave you as an investor? And that is where bonds step into the picture, right? They act as that quiet, steadying force in your portfolio. Our sources really make it clear how powerful that stabilizing effect can be, especially when the stock market is misbehaving badly.
Yeah, Common Sense on Mutual Funds has this really powerful example from the 2007-2009 crash. A brutal time for stocks. All equity portfolios they got played havoc with, just devastated. But bonds actually delivered a positive return during that chaos.
Oh, positive.
Positive. They did their expected job at moderating that risk. And it's not just about the money, it's about the psychology. That stability helps you stay invested when your gut is screaming sell. It prevents those panic decisions that can destroy value. That might be their biggest, often missed benefit.
Okay, so it's more than just income, it's protection, it's emotional ballast. But bonds isn't just one single thing, is it? There are different types.
Oh, absolutely not. It's a broad category. Essentially, your lending money could be to the government, think treasury bills, T-bonds, or corporations, or even local governments. They promise to pay you back the principal later, plus interest along the way. You're the lender.
Like being the bank.
Exactly. And Graham and Dodd, in security analysis, they really break down the different kinds, like treasury bills. They point out these have virtually no credit risk. Backed by the U.S. government. And because they mature so quickly, they're barely dented when rising interest rates knock down the prices of other income investments.
Yeah.
Plus, a little perk. The interest is usually free from state income tax, though not federal.
Got it. But, okay, fixed interest sounds safe, but Bogle brings up inflation, right? That even a bond's real value, what it can buy, can drop sharply if prices are rising fast. That's a key difference from stocks, where maybe earnings can keep pace with inflation.
That's a crucial point. Bonds protect against market volatility, yes, but not necessarily purchasing power erosion from inflation. And Graham saw this too. He noted periods where even the best long-term bonds lost a substantial part of their market value because of the rise in interest rates.
So no investment is totally risk-free.
None. But the core principle holds. Bonds do significantly lower the overall risk of your portfolio compared to just holding stocks. Graham emphasizes, if you cannot afford to take risks, you should probably be content with a relatively low return. It's always about that trade-off, finding your balance.
Okay, so stability, risk reduction. This leads us straight into asset allocation, deciding the mix. Bogle calls it a wise starting point for most investors.
Yes, exactly. It's fundamental. And the basic idea, reduce your stock percentage as you get older, increase your bond percentage. Bogle says that principle has been reaffirmed and then some.
It's about matching your investments to your life stage, your needs, your ability to handle risk. It provides that ballast, especially as you get closer to needing the money. Helps avoid those panic moves we talked about. Right. And speaking of fundamentals, there's one factor both Graham and Bogle just absolutely hammer home again and again. Costs.
Oh, yeah.
This isn't just what you invest in, but how efficiently you do it.
Cost matters.
Yeah.
Bogle repeats it like a mantra, and for good reason. It's probably the only thing you can reliably control in investing. He explains how even a percentage point or so difference in costs can just trivialize the impact of your investment returns over time.
Trivialize. That's a strong word.
It is. Think about it. Maybe 1% doesn't sound like much day to day, but Bogle shows over 30 years that 1% fee can easily eat up half of your potential gains.
Half.
Half. It's a silent killer. It doesn't make headlines like market crashes, but it's just relentless. Gives this example. A low-cost plan, 0.2% expense ratio, gets you 8.6% return. High-cost plan, 2.2% expense ratio, same 653 my stock bond mix, only 7.3% return.
Right.
That difference compounds massively.
That's the tyranny of compounding, the Bogle puts it, working against you. And he notes, for actively managed funds, when you add up all the costs, the stated fees plus hidden trading costs, it can hit like 3.5% a year.
Yeah, it's staggering.
Which means that active fund manager has to beat the market by 3.5% consistently just to tie the market return after costs.
An almost impossible bar to clear year after year, which leads us to
Indexing.
indexing. Exactly. Bogle shows pretty conclusively that passive index funds consistently beat most active funds. Why? Not magic. It's math. It's their substantial cost advantage.
Plus, he notes, broad market indexes inherently have lower risks than equity funds as a group because they're so diversified and aren't making big, concentrated bets. They just own the market, minus tiny costs.
And this whole cost argument, it applies just as much to bonds, right?
Yeah.
Which I think people sometimes forget.
Absolutely. Bogle found a hypothetical bond index fund was at the top of the return scale and the bottom of the cost scale. Think about this. The index fund consumed maybe 3% of its returns and costs. The highest cost active bond funds, they ate up 18% of the return in costs.
18%, that's huge.
It's enormous. It just underscores the power of keeping costs low, even in the supposedly safer world of bonds. Okay, but despite this, really clear evidence,
Yeah.
Bogle points out something odd, doesn't he?
He does. He highlights the surprising lack of low-cost bond fund options. The paucity, he calls it. He observes that only about 1 of every 20 bond funds has fees below 0.5%, which he saw as the absolute maximum fair cost.
1 in 20.
Yeah, and he's genuinely puzzled, almost angry about it. He asks, why aren't there more bond index funds? That paucity is appalling. It's a weird market inefficiency. Maybe people think bonds are too complex for indexing. Maybe active managers just have a stronger sales pitch in that space. It's hard to say for sure.
So when you put it all together, you see the role of bonds isn't about being dull or just for people nearing retirement. It's about building a portfolio that's robust, that's resilient. Something that can handle those inevitable fall and winter seasons in the stock market, as Bogle called them. It's about having that anchor when things get choppy and, crucially, not letting market panic force you into bad decisions.
Exactly. And connecting it all back, it's really about shifting your focus. Moving away from chasing those short-term, speculative wins that Graham warned about so strongly. It's about building a long-term strategy grounded in protection, stability, and disciplined execution. Like Graham advised, never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. Just don't chase performance.
Easier said than done sometimes.
Oh, absolutely.
Yeah.
But the goal is thoughtful asset allocation, matching your mix to your needs and risk profile, and relentlessly minimizing those costs.
Yeah.
Those insidious fees.
Right. It really isn't just what you own, but how you own it and how much you pay for the privilege. So thinking about all this, what really stands out to you? Are bonds maybe getting the respect they deserve in your mind now as this essential tool for long-term success.
And maybe here's a final thought for you to chew on. Bogle says, time is your friend, and compound interest is a miracle. So how might you look at your own investments right now and make sure that miracle, that tyranny of compounding, is working for you through low costs and a genuinely balanced, resilient approach and not silently working against you?